Welcome to the deep dive. This is your shortcut to getting really well informed on complex topics.
Right.
We cut through the noise, find those surprising facts, and hopefully add just enough humor.
Keep things interesting.
Exactly. Today, we're plunging into Kinder Morgan's Q2 2025 financials. But, it's more than just numbers.
Much more.
We're looking at the big trends shaping their future. We're using their own reports, their conference call insights.
The primary sources.
Yeah, and the mission. It's not just what they're doing, but why it matters for energy, especially natural gas.
And that's where we come in. We'll connect those dots, between the operational details, the financials, and that bigger picture. Global energy demand.
Looking behind the headlines.
Exactly, giving you that comprehensive view.
Okay, let's unpack this then. A glimpse into Kinder Morgan's Q2 performance. The headlines look pretty strong.
They really do.
Earnings per share, EPS, that jumped 23% to $0.32.
So that's a significant jump.
And adjusted EPS, which, often smooths things out, that was up 12% to 28 cents.
Still very solid growth in the core business.
Net income attributable to KMI, up 24% to $715 million. Adjusted net income up 13%, $619 million.
Consistent story there.
And adjusted EBITDA, that key profitability measure, hit nearly $2 billion, $1,972 million, up 6%.
Yeah, almost $2 billion. Impressive.
They also boosted the dividend. Daler 0.292517 per share for the quarter, that's $1.17 annualized, a 2% increase from last year.
And what these numbers really signal is not just growth, but really disciplined, efficient operations.
Right.
When you look at those adjusted non-GAAP figures, GAAP being generally accepted accounting principles, these adjusted numbers, they give you extra insight. They kind of strip away the noise, maybe asset sales, one-off things.
So you see the core health.
Exactly, the underlying health of the business. It shows they're growing profitably, sustainably, not just chasing revenue.
And looking at how they're using their capital, well, that tells a similar story, doesn't it? Strategic growth.
Absolutely. Big moves there.
They added $1.3 billion to their project backlog. That's their future investment pipeline.
A lot of future activity baked in.
And they actually put $750 million worth of projects into service this quarter.
So building and executing.
Cash flow from operations was strong too, $1.6 billion.
Very healthy.
And that left them with $1.0 billion in free cash flow after their capital spending.
And this is where it gets really interesting, how effectively they turn that operational performance into actual cash.
Right. Cash is king.
It really is. It fuels everything. New investments, shareholder returns. It's a sign of real financial discipline. And their balance sheet backs this up.
How so?
They ended the quarter with a net debt to adjusted EBITDA ratio of 4.0 times.
Okay, what does that mean in simple terms?
It means their total debt is about 4 times their core annual earnings, which for a company like this, in this industry, that's considered pretty healthy, manageable.
So they're not overstretched.
Not at all. They're well positioned to fund growth without taking on excessive risk.
So underpinning all these strong company numbers, there's this huge global shift happening.
A massive shift.
Richard Kinder, their executive chairman, put it pretty bluntly, an age of American global energy leadership.
Strong words.
And he had the facts. U.S. top global gas producer for 15 years straight.
15 years.
And since 2023, the world's top LNG exporter, liquefied natural gas. What's the real significance there?
Oh, it's monumental. And it's all about global demand. A chief economist, I think from a major oil company, predicted global gas demand jumps 25% in the next 25 years.
25%? Wow. Why?
Well, a huge driver is population growth. Another 2 billion people by 2050, mostly in Asia and Africa.
Emerging markets.
Exactly. And as they move into the middle class, their energy needs just skyrocket. And for many of them, LNG is vital.
Because they can't get pipeline gas.
Right. No local production, no pipelines. They need it shipped in. LNG is the solution.
And this point about security of supply, Kinder mentioned that too, the U.S. role being crucial for customers worried about disruptions from military actions.
That's become incredibly important, hasn't it? Recent global events just hammer home the need for stable, reliable energy.
And the U.S. is positioned well.
Perfectly. Abundant supply, great infrastructure. Look at S&P Global Commodity Insights. They estimate U.S. LNG feed gas demand. That's the gas going into the LNG plants. It's jumping 3.5 BCFD this summer compared to last year.
Right.
Billion cubic feet per day.
That's a huge amount.
It is. And they see it more than doubling by 2030. And here's the kicker for Kinder Morgan.
Yeah.
They already move About 40% of all that feed gas for U.S. LNG facilities.
40%, so they're right in the middle of it.
Absolutely. So when Richard Kinder says this positive natural gas story has legs and will last for decades, he's not just talking theory.
It's their core business.
It's fundamental.
Yeah.
A long-term shift directly benefiting them.
Okay, so strong foundation, favorable global picture. Seems like it's paving the way for KMI strategy. CEO Kim Dang called it the best opportunity set in 24 years.
I praise.
Projecting U.S. gas demand up 20% by 2030, mainly driven by LNG exports. What's making this opportunity so ripe right now?
Well, a big piece is what they call a supportive federal regulatory environment.
Meaning less red tape.
Essentially, yes. Things are moving faster. The Army Corps of Engineers is issuing permits quicker.
Okay.
And FERC, the Federal Energy Regulatory Commission, they've made helpful changes too, like increasing something called the prior notice limit by 50%.
Which means?
Streamlines approvals for certain projects. And they waived the 5-month waiting period before construction can start after getting a permit. For a year, anyway.
So they can get shovels in the ground faster.
Much faster. Cuts down delays. Plus, a recent Supreme Court ruling on NEPA, the Environmental Policy Act, that's expected to narrow environmental reviews, make nuisance lawsuits harder.
More predictable timelines.
Exactly. It all adds up to a more efficient path for building needed infrastructure.
But there's always a but, right? What about that fly in the ointment tariffs?
Oh, yes, tariffs.
KMI seemed pretty calm, saying it wouldn't have a significant impact. Maybe a 1% cost bump on 2/3 of their backlog. How'd they manage that?
They were proactive, really tackled it head on. They pre-ordered critical stuff, negotiated cost caps with suppliers.
Locking things in early.
Right. And they even secured domestic steel for the bigger projects. It's that kind of planning that lets them absorb those costs without derailing the projects.
Okay, so mitigating challenges, but also getting some tailwinds,
Yes.
like tax benefits.
Definitely some help there.
They mentioned a recent budget bill reinstated bonus depreciation and greater interest expense deductibility. Can you break those down for us?
Sure. Bonus depreciation basically lets them deduct a bigger chunk of a new asset's cost, like a pipeline, right away, in year one.
Instead of spreading it out.
Exactly. Reduces their taxable income up front, big help. And greater interest expense deductibility just means they can deduct more of the interest they pay on loans.
Also lowers the tax bill.
Right. Both powerful incentives. KMI expects meaningful benefits in 26 and 27. So much so, they don't think they'll be a material cash taxpayer until 2028.
Meaning they won't pay significant income tax until then.
Pretty much. Which raises a question, right? Does this change how they invest?
Good question. Do they lower their standards for projects?
Interestingly, no. They said it doesn't change their return thresholds. Their view is, for good return projects, there's unlimited capital.
If it makes sense, they'll fund it.
That seems to be the philosophy.
And clearly, they're finding plenty of those good projects. That backlog is growing. $9.3 billion end of Q2, up 6% from Q1.
That's a huge number.
And what really jumped out at me, 93% of that is natural gas projects.
93% tells you where their focus is.
And for the remaining $7.6 billion, they project a first-year project EBITDA multiple around 5.6 times. What does that multiple tell you?
So that 5.6 times multiple is basically how fast they expect to earn back their investment from the project's core profits. Lower is generally better, faster payback.
So 5.6 is pretty good.
Yeah, 5.6 suggests these are quite attractive, high-quality projects. And look at the allocation within the backlog.
What about it?
About half is tied to projects supporting natural gas power generation.
Power plants needing more gas.
Directly reflects that expected surge in electricity demand. It fits with what Kim Dang said, that quote.
The baseball analogy.
Yeah, we aren't in the first inning anymore, but we aren't anywhere near the seventh inning stretch.
Meaning there's still a lot of game left to play, lots of opportunity.
Exactly. Significant growth still ahead.
That is a great analogy. Okay, let's dig into some specifics in that backlog. Instead of just listing them, maybe group them. What are the big strategic buckets?
Yeah, that's a good way to look at it. I see sort of three main themes. First, connecting gas supply to those growing LNG export hubs.
Makes sense.
Second, boosting capacity for power generation. And third, strengthening their core regional pipeline networks.
Okay, give us an example for LNG exports.
The big one is expanding their Trident intrastate pipeline in Texas, taking it from 1.5 up to 2.0 BCFD. That's a $1.8 billion project due early 27.
Connecting supply to the coast.
Exactly. Katy, Texas to the Port Arthur area, a major LNG hub. Then there's the KMLP Texas Access Project, TAP. Smaller, $112 million, but it links Texas gas, including Trident's, over to South Louisiana, another huge LNG zone.
Connecting the hubs.
Right. And they just finished phase 2 of Evangeline Pass, delivering about 2 BCFD straight to Venture Global's Plaquemines LNG. It's all about efficient delivery for export.
Got it. What about power generation?
Well, they specifically added new projects like the NGPL North Extension and the Texas-Arkansas Power Project. These are designed explicitly to serve power plants.
Meeting electricity demand.
Precisely. That Texas-Arkansas one adds nearly 500,000 Drothedic of capacity just for power. Shows you where the demand growth is. Cleaner than coal, reliable backup for renewables.
And strengthening regional networks.
Huge projects there, too. The Mississippi Crossing MSX project, $1.7 billion, moving 2.1 BCD into the southeast markets. Big growth area. Expected late 2028. And the SNG and Elba Express South System Expansion 4, SSE 4, massive $3.5 billion project. KMI's share is $1.8 billion boosting capacity on their main southern natural gas line by 1.3 BCFD.
Ensuring reliable supply across regions.
Yeah. And you also have the Gulf Coast Express, GCX expansion, out of the Permian Basin to South Texas. Plus, that big investment, over $500 million in their Kinderhook gathering system in the Haynesville Shale.
Why the Haynesville focus?
Because production there is expected to boom, largely to feed more LNG export growth. They secured long-term commitments from producers, too, life-of-lease dedications.
So guaranteed volumes for their system.
Pretty much. It's all very strategic.
That paints a much clearer picture, thanks. How are the actual business segments performing then, amidst all this?
Okay, let's break it down. Natural gas pipelines, their biggest segment performance was up. Driven by the Texas Intrastate System, Tennessee Gas Pipeline, mainly thanks to LNG deliveries and new contracts.
Makes sense. Volumes up.
Transport volumes up 3%. But gathering volumes were actually down 6%, mostly in the Haynesville.
Oh. Why is that?
It's mostly producers ramping back up after lower prices last year. Not seen as a long-term issue, more of a timing thing.
Okay. What about terminals?
Terminals' earnings were up. Their Jones Act tanker fleet, those are the U.S. flagged ships running between U.S. ports, they benefited from higher rates, fully contracted.
Good for them.
And their liquids terminals did well, too, thanks to expansions and higher rates, particularly around the Houston Ship Channel.
Busy area. Products pipelines.
Products pipelines, contributions were actually down a bit. Weak commodity prices and some expiring contracts were the main culprits, even though volumes were actually up 2%.
Okay. And CO2?
CO2 earnings also down. Lower prices for CO2 itself and for D3RANs, those renewable fuel credits, partially offset by higher renewable natural gas sales, but still down overall.
So, mostly strong, but a couple of headwinds in specific areas.
Yeah, that sums it up. Natural gas pipelines and terminals leading the way.
So what does this all mean for you, our listener? Well, when you look at Kinder Morgan's huge existing footprint, all those assets plus their track record, building and running these massive projects.
They have a real competitive advantage.
Definitely. It puts them in a great spot to win new long-term contracts. They're kind of linchpin, aren't they? Connecting energy to homes, industries, here and increasingly globally. Okay, looking ahead then. Their 2025 outlook sounds pretty rosy. They expect to beat their original budget, which already had good growth baked in.
Yeah, very optimistic forecast.
They're projecting net income around $2.8 billion, up 8% from 2024. And adjusted EPS at $1.27, up 10%.
Strong growth expectations.
Now, that budget assumes oil, WTI crude, averages $68 a barrel, and Henry Hub natural gas averages $3 per MMBtu.
Important assumptions to keep in mind. Commodity prices can swing, obviously.
True. But it's not just them being optimistic, is it? The credit rating agencies seem to agree.
That's a key point. Both Moody's and S&P changed KMI's rating outlook to positive, Bay2 and BBB respectively.
And that's significant because
It's basically a thumbs up from the financial markets. Signals increasing confidence in their stability, their strategy, their future prospects. Based on earnings growth, conservative funding, good leverage, it's a strong endorsement.
a very strong vote of confidence. Okay, beyond the current backlog, what else is on their radar? Any new frontiers?
Absolutely. They're definitely looking ahead. One potential big one is the Copper State Connector,
What's in there?
a potential pipeline, maybe $4 or $5 billion, to serve gas demand in Arizona, driven by utilities and, importantly, data centers. Huge power users.
Ah, the data center boom.
Exactly. It's a competitive process. Tariffs make it complex, but the underlying demand pull is there.
Interesting. Anything else?
They're exploring behind-the-meter opportunities. Think delivering energy solutions directly to large users like hyperscale data centers. Partnering up, leveraging their supply and storage expertise, it's kind of a new angle for them.
Moving beyond just the big pipes.
Yeah, getting more integrated. And back in the Haynesville Basin, remember that $500 of an investment. That supports Wood Mackenzie's forecast of production doubling there. Facilities aiming for end of 2026 service.
Still betting big on shale gas growth.
Seems so. And finally, addressing concerns about Permian egress. Worries about too many pipelines out of the Permian.
Right, potential overbuild.
Their main pipes there, GCX and PHP, have contracts expiring 2029, 2030. But KMI seems pretty confident about recontracting. They think their rates are attractive and the pipes are so well integrated into their network.
Makes them hard to replace.
That's the argument. Low recontracting risk, in their view.
Okay, one last big question then. LNG. We hear talk sometimes about potential oversupply. Is KMI seeing any slowdown?
That's the million-dollar question, isn't it? Or maybe $1 billion. From KMI's perspective, the answer is a clear no.
No slowdown.
They are not seeing a slowdown in contracting. LNG developers keep announcing projects, signing long-term deals.
Why is the U.S. still so attractive for LNG then?
Several reasons they highlighted. Rule of law, first off. Stability for huge investments. Then, our advanced pipeline network allows for optimization, flexibility.
Good point.
Plus, a strong track record of developers actually getting these complex projects built. And of course, the sheer amount of gas supply available here, it gives international buyers confidence.
Security and reliability.
Exactly. Tom Martin, another executive, mentioned U.S. market share in LNG is actually growing. So their outlook is basically more to come.
The LNG story isn't over.
Far from it, according to them, still in the early chapters.
All right, let's try to wrap this deep dive up. Kinder Morgan's Q2. It's more than just good numbers. It really shows a company navigating this huge growth phase in natural gas incredibly well.
Yeah, fueled by global demand, favorable conditions here at home.
And their investments, pipelines, storage, gathering, especially around LNG and power gen, they seem really strategically placed, positioning them as a key player for the future.
And it comes back to that core strategy, right? Stable fee-based assets, smart capital deployment, financial health.
Discipline.
Discipline, their diverse assets, their long experience, it lets them really capitalize on these big macro trends. They're building the infrastructure that powers a huge chunk of the economy, here and overseas.
So here's something to think about. Considering the sheer scale of Kinder Morgan's infrastructure, both existing and planned, and that huge projected growth in global natural gas demand, what might that mean for the energy you use every day? For its cost, its accessibility? And what about the ripple effects on the broader global economy in the decades ahead?